All right, let's dive in. Today, we're going to pull back the curtain on one of the most powerful and, let's be honest, kind of mysterious institutions on the planet, the Federal Reserve. We're going to figure out what they actually do and how their decisions end up affecting everything from your student loans to the price of milk. So, let's get right into it. But let's start with a really big question. The Fed has this incredibly powerful lever to pull when the economy gets into trouble. But what happens when that lever just stops working? Or, to be more precise, what happens when you've already cut interest rates all the way to zero and you just can't go any lower? This is a huge problem called the zero lower bound, and it's really the central challenge we're going to explore.
And this chart, wow, it just lays the problem out so clearly. Look at 2007, before the big financial crisis. The Fed's main interest rate was up over 5%. That's a ton of room to cut if they need to give the economy a boost. But jump to 2009, they'd sliced it all the way down to basically zero. They literally hit the floor. And then it happened again in 2020. Their number one tool was pretty much out of ammo.
So to really get how they handle a situation like that, you gotta understand the institution itself. I mean, who are the people making these massive economy-shifting decisions? It's time to go inside the Federal Reserve, or, as everyone calls it, the Fed. Okay, think about it for a second. Who has the most direct, day-to-day power over the U.S. economy? Is it some tech billionaire? The CEO of a giant bank? You might even think it's the president, right? Well, the real answer might not be who you think it is.
Yep, it's the chair of the Federal Reserve. That one person, just by leading a committee and saying a few words, can send global markets soaring or send them into a nosedive in a matter of minutes. And they lead a board of governors that's intentionally designed to be an island, insulated from all the short-term chaos of politics.
And you can see exactly how they built in that independence right here. The board members serve these super long 14-year terms, and they're staggered, so no single president can just come in and stack the board with their people. Crucially, their policy decisions are their own. They don't need a permission slip from Congress to act. The whole point is to let them make tough calls based on cold, hard economic data, not on what's popular or who might win an election. Okay, so they've got all this independence, but what do they actually do with it? Let's open up their toolkit and see what powers they have. This is the world of monetary policy.
It pretty much all boils down to two modes. When the economy's in a slump, they go with expansionary policy. Think of it as hitting the gas. They slash interest rates to get people and businesses to borrow and spend more. But if the economy's running too hot and prices are going up everywhere, that's inflation, they slam on the brakes with contractionary policy, raising rates to cool things down.
Now, the Fed's classic bread and butter tool for doing this is something called open market operations. Sounds super technical, but the idea is actually pretty straightforward. When the Fed buys bonds from banks, it's basically pumping cash into the banking system. More cash means lower interest rates. When it sells bonds to banks, it's sucking that cash back out, which nudges rates up. But remember that whole zero lower bound problem we talked about? When your main interest rate is already zero, that classic tool doesn't really work anymore. That's when the Fed had to pull out the big guns, quantitative easing, or QE. With QE, they go out and buy massive amounts of long-term bonds, trying to directly push down the rates on things like 30-year mortgages. It's a powerful, unconventional move, and, it's pretty controversial. Some folks worry it can create dangerous bubbles in the market. And here's one of their newer, more surgical tools. The Fed can now pay banks interest on the cash they just keep parked at the Fed. Think about it. By raising that rate, they're basically saying, hey banks, you can earn safe money just by leaving your cash here with us. That makes them less likely to lend. If they lower it, they're encouraging banks to lend that money out into the economy instead. It gives them a really precise way to fine-tune things. All right, we've talked about all these technical tools. Open markets, QE, IORB, but what does any of this actually mean for you? Let's connect the dots and see how this all affects your wallet, using that simple idea of a gas pedal and a brake pedal.
So when the Fed wants to hit the gas, they put expansionary policy into gear. They cut interest rates. All of a sudden, that car loan you were looking at is cheaper. That mortgage is more affordable. Businesses see lower borrowing costs and think, hey, now's a good time to build that new warehouse. All that extra spending and investment makes the economy speed up, which hopefully means more jobs.
But what about when things get out of hand? The economy's overheating and the price of everything is going up. That's when the Fed has to hit the bricks. They raise interest rates. Now your credit card costs more. That mortgage payment is going to be higher. Businesses will put big projects on hold. people and companies pull back on borrowing and spending, the economy cools off, and that helps get inflation under control.
So it all sounds pretty simple, right? A gas pedal to speed up, a brake pedal to slow down. Easy. Well, the reality is so much more complicated. The Fed is basically trying to drive this giant, complex economic machine down a very bumpy road, in the fog, looking through the rearview mirror. There are some serious pitfalls.
You know, there's this classic analogy in economics that just nails the biggest challenge they face. Hitting the brakes, raising rates, is like pulling on a string. It always works, right? You can always pull a string. You can always raise rates high enough to choke off an economy. But hitting the gas, lowering rates, that's like pushing on a string. If everyone's too scared to borrow or lend, the Fed can cut rates to zero, but the string just bunches up. Nothing happens.
And that whole pushing on a string problem really gets at these core challenges. First, there are huge delays. It can take a year, 2, even 3 years for a decision made today to fully work its way through the economy. By then, the whole situation could have changed. And it gets back to the banks. The Fed can offer cheap money, but it can't force a nervous bank to actually lend it out. It is absolutely not an exact science.
So we've seen how the Fed had to literally invent new tools like QE on the fly when their old ones weren't cutting it anymore. But we live in this wild world of constant, unpredictable global shocks, which leaves us with a huge lingering question. Are the tools the Fed has right now, from the old classics to the new unconventional ones, really going to be enough to handle whatever the next crisis throws at us? That really is the trillion-dollar question. Thanks for joining me for this breakdown.